I think, Alex, this is a very old holding, and I think looking at the kind of asset quality of Indian Overseas Bank, I think it's better that he switches over to something better like a federal bank, or maybe something like maybe a Bank of Baroda if he wants to stick to some public sector bank. IOB definitely has a smaller size balance sheet, higher degree of asset quality issues. So I think a federal bank would definitely be a better option from the private sector space. In fact, the business commentary from the Q1 has come out very strongly. Their CASA ratio has also significantly improved. And I think the risk reward in federal bank looks far better than IOB. So I would suggest the investor should make a switch, because here I think it is unlikely that he could recover his cost price. And at the same time, federal bank would offer a better risk reward over the next, say, 12 to 15 months. I think we must understand one thing, that IEX was a monopoly with a market share of almost 98%. And the market for power trading in India is very large. So, it's hardly about 5 to 6% where, ground has been covered here. So my sense is that despite the fact that another power exchange comes in, it is not going to make IEX a marginal player. In fact, market share will definitely reduce, because obviously more competition means market share is going to be eaten away, but it's not going to be significant. And at least over the next couple of years, this market supremacy is going to be maintained. And I think the investor should realize that these things are very normal in a business where earlier there was just one player and now there are going to be another one or two players. So I think business opportunity still continues to be very large. The headroom for growth is extremely very, very large, and that should not bother an investor for IEX. Although in the very near term, the markets could obviously give a negative kind of discounting to IEX. But once the numbers come out, the financials speak for themselves. I think you could see a good uptick on the IEX stock. I think, Alex, he can continue to hold on, because see, as far as the QSR business is concerned, I think this is one space where the revenue is going to grow by at least 25-30%, not only for Jubilant but for the entire sector as a whole. And I think post the COVID, normalcy has come in now. A lot of people are going out and eating out. So I think the dine out business, which was actually completely absent previous year, is now going to also contribute significantly. Plus, Jubilant has also introduced some new food varieties in its food menu. So that is obviously going to add to its realization going forward. So I think if he's got a 2 year plus view, he should continue to hold on. I would not be surprised that the first quarter numbers for FY23 should be quite solid. Very important numbers would be the same store sales growth, which I think in the past 1 or 2 quarters was slightly below expectation. But if that improves, then I think you could see a significant re-rating not only in the medium term but even in the short term. So continue to hold on. Definitely a good risk reward can happen over the next couple of years. Alex, TCS is one company which has generated immense wealth for shareholders in the last 10 to 15 years. In fact, I remember, ever since people actually applied for the TCS IPO, they have benefited significantly in terms of bonus and buybacks. In fact, they have made 4 buybacks, and all the buybacks have generated a lot of wealth for the shareholders. So I think if the investor has a 3 to 4 year view, I think definitely IT in business in our country, considering TCS bandwidth and capability, is going to grow significantly. But there would be ups and downs, and obviously every sector goes through cycles. So if one were to look at the next 2 years, which is a more realistic picture, I would believe that post COVID they've done a lot of work on cloud, digital, and I think the recent management commentary has been very strong. The rupee tailwind would obviously add to the benefit of the company. So I think if you are thinking of buy TCS in small SIP kind of bits and pieces, which would give you a better risk reward over the next, say, 2 to 3 years. I think my sense is, I think if he has got a 2 to 3 year view, then HDFC Life can definitely be accumulated again in a SIP format, not in a lump sum kind of process. What is important is that insurance is a very large sector, and I think companies like HDFC Life have got a very large business presence because of their parentage. Most importantly, they've been very profitable, and I don't think fundamentally the business is at risk. In fact, over the next, say, 2 to 3 years, the balance sheet size as well as the business opportunity size is very large. So he can accumulate a little more stocks at the current odd levels, but again via SIP route. And as far as allocations are concerned, Cheryl, I think technically, we always advise our clients that they should not go beyond 6 to 7% in every stock. So I think beyond that, it's unadvisable to take a very large exposure on insurance. because that exposes the portfolio to one particular sector or one particular stocks in a significant way. So I think keep your allocations tight around 6 to 7%, and I think if he has not done that, then I think he should aim to actually increase his allocations up to this level. Alex, giving a view for 20 years is little difficult, because as all of us agree that many things change over a longer period of time. But I think over the next 5 years, I would say that electric vehicles is one area where possibly a lot of changes as well as development and progress is going to come in. And here I think a company called KPIT, which is basically largely catering to the electric vehicle sector, is definitely bound to benefit significantly. If he wants a direct exposure in electric vehicle, component manufacturers, then he can also look at a company called Sonacom, which is basically a company which is largely focused on the electric vehicle business and is progressing very well. Yeah, I think Alex, the investor can hold on to Hindustan Unilever, because my guess is that after a span of almost 2 years, the FMCG sector is now looking quite attractive, considering the fact that good monsoon would boost up the volume growth. Secondly, as you rightly mentioned, palm oil prices have corrected sharply, and that is a key raw material for most of the FMCG companies. So margin expansion is going to happen. Plus, agro commodities, have also prices have come down. So that is also going to benefit, companies like Britannia, or for that reason, Lever. And that is definitely going to get reflected in their EBITDA margin. So I think if the investor can hold on for the next, say, 12-15 months, definitely 23 is going to be a better year compared to last year. And I think Hindustan Lever, being one of the market leaders, would obviously benefit both in terms of the market share as well as the price upside. So continue to hold on. Alex, ITC seems to be at the right time in the right business, considering that all its businesses now are expected to do well. In fact, the cigarette business has shown very strong volume growth last year and should continue in the current year also. But I think FMCG as a pack also should do well for them. They have the hotel and the paper business also, which is showing good signs of buoyancy. So my sense is that over the next, say, 12 to 15 months, all the levers for growth for ITC look well positioned. And in terms of margins, they've already done very pretty high margins. They enjoy ROEs of in excess of 25%. The company is a free cash flow generating machine. So my sense is that even at these levels, if the investor were to buy, he could expect a decent upside here. So continue to hold on if you have it. But even if one were to buy the stock at the current levels, one could expect levels of 330, 335. So I think within the FMCG pack, or maybe as a diversified player, ITC definitely should do well over the next 12 to 15. I think my sense is he should continue to look at this stock from a long-term perspective, because the overall export basket of this company is doing well. In fact, there are many HNI investors who have entered this stock at lower levels and still continue to hold on. I would believe that the agro business as well as the pigment business and the export business should do well in FY23. Certain cost pressures had made the company underperform in the last 1 or 2 quarters. But if the investor is looking at the next 12 to 18 months, I think he should hold on. This definitely has a bright future, and I think overall FY23 should be a lot better. Alex, if you have a 2-year kind of view, then I think this stock can definitely make a decent amount of money. I think this is not one of those stocks which is very volatile, because largely PSU companies are slow movers. But if you look at the balance sheet, if you look at the order book, they have an order book of almost 4.5 to 5,000 crores. So I think clearly, if one were to look at the long-term prospects, defense as a sector is definitely in flavor, and this company should do well. I think keep a time frame of at least 1.5 to 2 years, because obviously you could get the real benefit only if you give this kind of time frame to this company. Yeah, I think Cyril, this is one of those unique companies which is into a very exclusive space. MapmyIndia is into basically mapping, and which is the only company after Google to do it. In fact, of course, MapmyIndia is a very small player as compared to Google. But I think the opportunities which this company is looking at is immense. I think they are large, suppliers to mapping services to the automotive industry, and they've got a lot of local and international companies as their clients. I think many more segments are likely to be covered in the next 2 to 3 years, and it's a technology savvy business, because it's all about technology, and it's all about how you scale it up in the given opportunity. So I would suggest that if the investor has a long-term view, definitely this is one company one should hold on for a time frame of at least 1 to 2 years. The stock has done remarkably well after its IPO, but definitely some more re-rating will happen only when the company puts out some more customer lineup and more segments which it wants to cater. So continue to hold on, but keep a time frame of at least 1 to 2 years. Cheryl, exactly what Kunal said, that timing is very important, and I think this company is going to do extremely well over the next, say, 2 to 3 years. So because it's not a typical IT services company, it has got IT embedded services, plus it caters to a lot of growth sectors like telecom, media, entertainment, and obviously medical devices. So I think going forward, they've been also trying out technologies on driverless cars, which is also a very large kind of segment which is going to emerge very strong, not only in the developed markets but even in Indian markets going forward. So my sense is that I think he should continue to hold on, because growth here is going to continue, and despite the fact that the stock has now become a larger stock in terms of its base value, earnings growth over the next, say, 2 to 3 years are still going to be strong. And as long as earnings growth continue to be strong in the region of, say, 20-25% every year, I would not be surprised that the stock would continue to scale new highs. So continue to hold on, and I think there's no need to book out profits in the stock in a hurry. Maybe the investor can book out and recover his capital, but he should continue to hold on the rest of the quantity for a further upside over the next, say, 2 to 3 years. Yeah, I think he should hold on. Prospects look pretty good. So Elxsi should continue to hold on.
Mtar Tech, do you think it's a good buy at current levels? Ganesh wants to know.
Yeah, I think from a longer term perspective, I think it definitely looks attractive considering its order book and the kind of products it caters. So continue to hold, and I think you can always look at buying on decline. Consumer durable spaces again started looking up, and I think with a good monsoon, most of these companies, including HUL, should do well. So continue to hold on.